Welcome back to Master Your Money and Mindset, the show where we connect the practical side of personal finance with the mindset shifts that help you feel confident and in control. As we wrap up another year or get close to the end of the year, it is the perfect time to pause, take a breath, and check in, not just with yourself, but with your investment portfolio. A lot can happen in 12 months. Markets move and interest rates change, and life just throws a million surprises our way. And all of that can shift whether your investments still line up with your goals and with your comfort level that you have with risk. I am certainly no expert, so joining me is John Foreman, VP of Investments here at Barnum Financial Group. John is going to be doing all of the heavy lifting today. So John, welcome to the show again.
Thanks for having me today, Elizabeth.
My pleasure. So today, like I said, we're talking about helping everybody conduct a year-end investment review, which I know is not the funnest or sexiest thing to do this time of year, but we both know that it is necessary. So we're going to talk about why it matters and how to truly know if your portfolio is working for you. As always, I'll say this a million times throughout the show, you always want to work with a financial professional before making any investment decisions. So we are here to teach you, we are here to learn, but your decision should be based on your goals and your situation, and your financial professional should always know that and guide you. If you don't have a financial professional, please reach out to us. I can hook you up with one of the many great ones here at Barnum Financial Group. All of our information is in the show notes. Okay, John. So today, we are going to talk about 3 core steps. We are going to talk about rebalancing. We're going to talk about evaluating performance, and we're going to talk about diversification. Okay. And then lastly, we are going to end with talking about how your portfolio fits into the bigger picture of your life. Okay. So by the end of this episode, you listeners out there should have a clear sense of what to look for, what to adjust, and how to head into the new year with confidence and alignment. Good, John?
Sounds good to me.
Okay, beautiful. Why is the end of the year such an important time for investors?
Well, so I think it's a couple of things. Number one, there's various activities that ought to be completed before the year is out, right? For those who are of retirement age and maybe facing RMDs, they need to start taking their RMD before the end of the year. And that's a great opportunity to just generally evaluate their portfolios. Where should they potentially take money from? Should they be doing a rebalance of said portfolio? But either way, that's an activity that needs to occur at the end of the year. For others, maybe it's about making a contribution to their IRAs, their Roths, or something to that effect before the year is out. For investors who have taxable accounts, it's an opportunity to start to evaluate positions that have either gains or, more importantly, those that have losses, where they could potentially harvest those losses to offset gains that have maybe been recognized throughout the year to try to improve their net taxes at the end of the year.
So there's best practices, like what we're doing is certainly a best practice, taking a look at things, but you're saying there are steps that would impact your 2026 if you didn't take them in 2025.
Correct.
That could be very costly.
Yes. A lot of it is around taxes. Correct.
Yeah. And that's where you want to talk to your financial professional to know exactly what you need to do, what you qualify for, how much of these contributions you need to make.
Yes, absolutely.
Great. Speaking of that, what are some of the most common mistakes you see that people make when they skip an annual investment review? So when people don't do this process?
Well, skipping an annual review is a lot like skipping a regular checkup with your dentist or your doctor, right? A lot can happen throughout the course of the year. A lot can happen to your health. A lot can happen to your portfolio. If you miss that, things start to kind of go south, right? Miss an appointment with a dentist, next thing you know, you have a cavity, and that's more expensive and more painful to fix than if you had just addressed it in the first place.
And you're putting out a fire.
Exactly. You're putting out a fire, and then there's time that's been lost, right? Maybe a year has gone by, and that's lost time, and we can never get that back.
Yes.
And in investing, time is one of your greatest assets.
Oh, I love that. The loss of time.
The loss of time, right? Maybe we didn't rebalance and we let our portfolios run too much, or maybe we had too much cash on the sidelines that had it been invested would have been able to grow more quickly. Or maybe there's some sort of other external thing in our life that has changed that requires some sort of adjustment to our investment approach. And had we addressed it at the time, we would have been better able to adapt. But we've lost that time. And when you lose time and you lose opportunity, you lose the choices and you lose your flexibility to adapt to whatever maybe has come to you.
You can't get it back.
You can't get it back.
You work at Barnum, you work with both advisors and clients.
Correct.
So you are client facing, but you also, help advisors because you're the investment specialist at the firm. Do you see a lot of people who tend to maybe bury their heads, or they get nervous because maybe they didn't use time to their advantage, or maybe they wish they did things that they didn't do, and now they're kind of paying the price for that?
Yes, we see that a lot. It's multifaceted, right? I think just like going to the doctor or the dentist, it's not one of those things that everybody really wants to do. Yeah. I don't want to carve off 3 hours to go meet with my advisor and get all these documents. At the same time, then we may run into situations where people haven't addressed this for maybe years, right? They could be later on in life, be like, oh man, I should really start thinking about saving for retirement, or this, that, and the other thing. And that time that's been lost now creates a far different situation where they're now maybe putting too much pressure on their investments to make up for the time that has been lost.
And it's stressful.
It's stressful, right? What makes it even worse though sometimes is because it's one of those things where it's like, it's such a problem that now I'm just like, I just don't even want to deal with it at all. So I'm just going to continue to let it fester and grow and go and become worse than it already is. So whatever's happened has happened. Let that be what it is. Move on from that, and let's be proactive and take the right steps going forward, regardless what has happened, because that's the only path forward to being in a better position.
I love that you said, I couldn't have planted those words, and I didn't, folks, but I couldn't have planted those words any better. And that's kind of what I was getting at, because I know I'm always vulnerable on this show. That's a money habit for me. Like, I get so upset at myself. I tend to do nothing, which only makes my problems worse. It does not make them any better.
Yep. It's like starting a diet, right? Be like, I really got to diet. I'll do it tomorrow. I'll do it tomorrow. Next thing you know, it's 3 years ago. And you're like,
yep, you're in worse shape than you were. Yep, I totally get it. But I think that's a very common feeling. Yeah. Whether it's shame, embarrassment, whatever you're feeling.
It's also complicated.
It is very complicated.
Sometimes there could be, people are, to your point, maybe embarrassed. I don't know enough about this, and I'm embarrassed the fact that I haven't done anything about this. And I just don't want to deal with it. So maybe magically something will happen. But.
Yes, you're just hoping everything works out. We always say here, hope is not a strategy. Right. But the best time to do anything is right now. Yeah. So try your best as you reflect on the past is the past. Yep. But the best thing you could do is take some sort of action today.
And it doesn't have to be, we don't have to get it all done all at once, right? It can be baby steps. So let's at least, first step is at least meet with somebody, consult with somebody, start to get some sort of a game plan together. What is reasonable and actionable for you to be able to accomplish? Just like if you're starting an exercise program.
Fair.
We're not throwing you out there with 300 pounds to squat, right?
Like, very fair.
Let's start with some whatever.
And
easy.
Your financial advisor can guide you through that process.
Yes. And then we ramp up as you
go.
Progress.
So let's talk about rebalancing. What does that mean? So
rebalancing is, there's the old adage in investing is, buy low and sell high, right? Well, rebalancing is that to its core, right? When you invest in a diversified portfolio, conceivably you will have some assets that do well and some assets that don't do so well over a given period of time. And then there's a natural sort of reversion to the mean, if you will. And those that have done well will maybe not do as well going forward. And those that didn't do so well will start to do better, right? And so what you do through time is you just rebalance, which is let's sell those things that have done well, take the dollars from that and reallocate it to those things that haven't done as well. Whether that's U.S. stocks versus international stocks, or whether that's just stocks versus bonds. You try to do that to, again, capture this buy low, sell high, reversion to the mean, or most importantly for a lot of folks is manage risk, right? So if you start with a portfolio that is, say, a 60-40 allocation, 60% stocks, 40% bonds, we have a great year in the stock market. Well, now the portfolio allocation could be 70% stocks and 30% bonds because the 60%'s grown a lot. And that by its very nature is a more risky portfolio as you have a greater exposure to stocks. More risky from the standpoint, there's more volatility, more ups and downs, and you can see your portfolio drop if we go through a more difficult period of time in the market.
it's a fancy investing term, but like everything you explain, John, you make it seem so simple. And I love that. You're so good at taking things that are complex and just making them seem simple. But it's truly what it is. It's just rebalancing. It's getting yourself back to square one where you want to be.
Yeah, it's resetting back to square one. And typically a lot of people will do that at the end of the year, whether it's in December or come January. A lot of people will start to make that evaluation. Oftentimes January is a time when folks will do that as when working with their advisor, all of our various investment partners and all the analysts and strategists. Oh, here's what we think for next year, whether or not you take that.
So once you have an economic outlook.
Yeah, you may take that into consideration in the margins, but you do want to consider like what your high level allocation is for where you are.
But rebalancing, could that often get confused with being like too active? Like you want to rebalance like once a year or twice a year?
Well, you could look at rebalance. I think there's a couple things that would go into that. One would be the taxation of the account and its intent over the long term, right? If it's a taxable account and it's geared for long-term, growth of capital, right? Maybe that's not a situation where you rebalance that, maybe to your point, like say once a year or something to that effect, or maybe to delay that a little bit because you do have sort of that longer term horizon. For those accounts that maybe are non-tax or qualified accounts like IRAs and the stuff where taxes aren't much of an issue, you may take the approach of rebalancing on a cadence that is either on a more frequent rebalance based on a calendar turn, or you could say, look, I want to rebalance when the market gives me an opportunity. Meaning, okay, we've had a really nice run in the market for the first 6 months of the year. Maybe decent time to rebalance. Or hey, it's just been a significant drawdown like we saw earlier this year during the tariff turmoil. This is a great opportunity to rebalance. Market's just sold off 20%. Hit the rebalance button, right? Take advantage of the fact that some things are down, other things have held up. Sell the stuff that's held up and buy the stuff that's out.
Is it a fine line though between rebalancing like that and being emotional?
Yeah, well, yes. And that's where having a partner in crime, so to speak, an advisor is there to help be another sort of voice of reason.
Define that. Yeah.
Yes. Because you could get carried away with it.
Yes, correct. That's what's going through my head.
Yeah. And the challenge is, especially when markets are down, that's when it's difficult to have that courage to say, you know what, I should just rebalance and let this happen. Oftentimes we'll see people who are investors who are reluctant to rebalance when the markets have already sold off 20% because that part of their brain that's triggering the fear response, that fight or flight response, is alarm bells are going off and they're saying, you know what, I'm paralyzed by all of this and can't do it. So having an advisor to be, that more rational voice can be helpful.
So rebalancing with a plan and an advisor versus just waking up one day, listening to the news.
Listening to the news is probably the least effective.
The least effective and helpful.
Yes. Yeah.
So there you go, folks. That's the clear difference. Because
they prey on that fear, what's that part of your brain? The amygdala or something like that?
Yeah, you're right. You're smart, John. Investments and science.
Oh, boy.
And
nerd alert.
So we talked about, we kind of covered this question that I had, but I think we just answered it. The point of where rebalancing too often becomes counterproductive.
Yeah, it can be, because the reality is you're like, you go from 60-40 to 61-39. Like that's not enough of a difference to make a difference, right? And given ebb and flow of markets over a period of time, you're not going to see massive changes.
Yeah.
But it is important. There will be times where there are dislocations amongst asset classes. We saw that a little bit at the beginning of this year, where U.S. equities were not doing very well in their first quarter, and international was holding up very well, if not appreciating and outperforming by a significant margin. Okay. Tariff turmoil happens and that sort of dynamic reverses, and U.S. has started to outperform international, right? So if you'd been able to rebalance at that point in time, you might have been able to capture a little bit here or there. Done enough times over time, 30 years, those little bits start to add up to having an impact.
Okay. Switching gears, let's talk about market volatility, which is everyone's always favorite subject. But if your portfolio took a hit in 2025, how does that 1 year long volatility affect your entire portfolio over the course of your lifetime?
Well, that's a good point, right? So earlier this year, we saw a 20% drawdown in the S&P 500 around into early April around tariffs. 20% is a dramatic amount. It seems very scary. And yes, from a absolute point decline and all that kind of stuff, it's a lot. And when you look at say $1 million portfolio that's now worth $800,000, like that feels like a lot. I think what's important to remember is this type of volatility, those types of declines happen consistently over and over and over again throughout time, right? It happens many times. You get 10% drawdowns a couple of times a year. You get a big one every 3 years, even larger ones every 4 or 5 years, right? Those things happen quite frequently in reality. I think it's instructive and helpful to look back at time and look at a chart, right?
Yes.
Just look at chart,
Yes.
zoom way out. And look at a chart, key in on, the crash of 87, right? You won't even be able to see it on the chart. At the time, it was one of the most harrowing things going on at the time. Look at 1997 when we had the Russian ruble default. Like that was a really challenging and scary time. We had even times more recently, whether it was around the Great Financial Crisis, which was a long and drawn out, that's going to stand out on the chart, right? But the shorter term ones that only go on for a couple of months, even could be a couple of weeks. It's important to stay mentally strong through some of those periods of volatility.
And almost to expect it.
You have to expect it.
You have to expect it.
You have to expect it. And again, this ties back into having a plan of some sort, right? I think the important part of having a plan is making sure you have optionality. I have choices when something like that happens, right? Hopefully I have the choice to maybe rebalance. Maybe I've got some other dollars on the sideline that I've earmarked for out for contribution over time. Or if I am in a distribution mode, I have built into my plan or my process, like, okay, I've got dollars reserved for, hey, market's on the fritz. I'm not going to spend those dollars, those market dollars. I'm going to spend these other dollars that are here in my reserve bucket while I wait for that recovery.
Okay. So having a plan, like you said, time.
A strategy.
Yep. And always working with somebody.
Right.
How do investors shift? I mean, you kind of just talked about this as well, but when and how should investors shift toward a more long-term perspective? Is it in those moments? Like, is this where the mindset of investing comes into play? Like when you feel yourself getting emotional, nervous, scared, and then you want to take an action? Yeah,
I think it's multifaceted. I think everybody should naturally just approach this with a positive long-term view, right? You look at a long enough chart of the stock market, it goes up, right? And on average, the stock market is positive in any given year, 75% of the time. The odds are in your favor for the stock market to go higher. So you should probably naturally play those odds. That's really difficult though, right? It's much easier to be bearish, right? It's much easier to be pessimistic because if I'm wrong about being pessimistic, well, the stock market went up. So I made some money, right? Probably what ultimately happened though, you won't realize it is you probably hurt yourself a little bit by being too conservative, by being too pessimistic. You've missed that opportunity, right? Okay, I should be, given my age, time horizon, so on and so forth, I should be allocated, this way, but I've let my imagination and the talking heads on TV get the best of me. And I've been a little bit more conservative than that and may have missed out on potential appreciation.
It's such a fine line.
It's a mental game all day long.
It's a mental game all day long. And that's why we can't stress enough that you have to work with somebody. You have to.
Getting clear about what the time horizon, the goals and objectives, like what is this money for and when am I going to use it, really helps inform the strategy.
Well,
right?
That's a perfect segue to my next question, which was around goals. What is an appropriate, what type of goals, investment related goals do you see? Do you come across? Is it truly, I just want to invest X amount? I want X rate of return. I need this account to generate enough to pay for college. What do you see out there?
So I think goals need to be connected to a real life activity, right? I need to save for a house. I need to save for college. I'm saving for retirement. I want an extra discretionary pool of money to maybe pay for my daughter's wedding at some point, right? Those are actual goals.
Okay.
Right?
So just a blind goal of I want to save more or.
Now we can back into, okay, I've got X money today for said goal. Now we can talk about what rate of return do we need to get from here to there to achieve that dollar amount to pay for that thing, right? Daughter's going to get married. It's going to cost $100,000. I've got 35 today. what sort of, based on analytics and metrics and all this kind of stuff, how should I invest this that over the next 10 years, I think it can grow it to that number.
Yeah.
Right. That's kind of like where we start to back into like, what should the asset allocation be for that portfolio? And then to that point, it's like, is that allocation going to achieve that goal within your tolerance for risk?
Yeah.
That might be an all equity portfolio. It's going to go up, it's going to go down and all that kind of stuff.
Just don't look at it.
And that might give you some agita.
Mm-hmm.
Okay. You're uncomfortable with that amount of risk. We can dial back the allocation of the portfolio, make it a little bit less dramatic. But Elizabeth, you're going to have to add X dollars to this every year between now and then. Is that within the budget, or do we have to figure this out? Or maybe we have to modify how much we're going to be able to spend on your daughter's wedding.
Okay. So it's truly about having a specific financial goal or obligation in mind.
Yeah. And then we can track to that,
yes,
right?
And then you build your portfolio and your decision-making matrix around achieving that specific goal.
Right. Now we're measuring, okay, are we achieving the rate of return, the required rate of return to meet the goal, rather than measuring ourselves, oh, the stock market did this, how'd I do? Like,
yes.
That's not, the goal wasn't to beat the stock market.
Yes.
Right? The goal was to get enough money between now and then
to do whatever,
to pay for your daughter's wedding.
More often than not, do you see that attached to retirement?
Yes. Yeah. Oh yeah. We see, I mean, listen, performance is important. You know, it's always, as a portfolio manager, like I'm always comparing to some sort of scoreboard. The scoreboard keeps changing all the time, right? You know, it's not easy.
Yeah.
But the reality is, like, in personal finance, the connecting to the goals and coming up with sort of like, how am I going to get there, is what we should be measuring ourselves and benchmarking ourselves against. Again,
so simple, but so obvious. Like when I think about investments, it's more of just, I want to invest and save however much is humanly possible.
Right.
But sometimes it doesn't work out because a lot of other things sneak in.
Right.
So saying, okay, I know I want to pay for X and I'm going to use an investment strategy to get there.
Right.
That's a new way of thinking for me, which I love. Do any major life changes have an impact on how somebody should view their portfolio performance? So a marriage, a divorce, a death, job change.
I don't know if it's about their portfolio performance. I mean, the performance will be what it is, right? Yeah. I think it's these life events should maybe change the way they approach investing or their strategies. So very often, my personal way of thinking about it is like for retirement, right? You're climbing this mountain, you reach the pinnacle. That is the day you retire. And then from there on, we're kind of going back down the mountain, right? So we've saved as much as we can to the top, and now we're going back down. Well, the strategies I use to get to the top of the mountain are not going to be the strategies I use to get back down the mountain, right? It's a different game. And the challenge for a lot of folks is, you know, they've been a saver and they've been an investor for 40 years going up the mountain and using those strategies up the mountain and have a certain amount of experience and perspective going up the mountain. They've never gone down the mountain. They don't know what going down the backside is. And those same strategies may not be the ones that are going to work. You know, certainly as you're going up the mountain, being opportunistic, taking advantage of market drawdowns, being a little bit more risky can, you know, work to your advantage, especially in the early days. When you're on the backside, it's like, okay, we have to be cognizant of the sequence of return risk. You know, what if the first 3 years of my retirement, we have really rough market conditions, right? And that's where having a plan, a strategy to deal with that outside of a trading strategy or some sort of investment strategy, or a larger sort of plan is beneficial. It's a mindset of maybe I'm at peak wealth on the day I retire might be helpful in that regard. I don't know. I kind of think about it that way because you are going to start to rely and live off of these assets, right? To think they're going to continue to grow at 20% a year while you're spending them is a little unrealistic in my mind. Which, when you gave that example, that's immediately what popped into my head. That the strategy that a lot of people, I don't think about is what it feels like to truly not have an external source of income. It's scary. Like that has to be scary. It's scary, right? And that's where, and people can make mistakes that way, right? Like, you know, there's an adjustment period. I found that working with investors who are hitting that retirement phase, there's probably a good 9 to 12 month adjustment period of really getting clear. I'm like, what is my cash flow? What am I spending things on? Is it more or less than what I estimated, right? We don't know really. We can do all the, the minutia and the plan, and you can forecast this, that, and the other thing. But until you actually see what Elizabeth is actually spending
you have grandkids.
Like, Lizzie, You were spending a little more than you thought. Well, it was just a little bit here, a little bit there. Be like, okay,
yeah,
we need to make some adjustments.
Yeah, we always joke with my parents because they spend, which I'm so blessed, but they spend so much on our grandkids that we always have to be like, I don't think you have that much. I think you may have to double check that account. They want your love more than anything else.
Yep.
Okay, so not so much really life goals, but more so preparing for retirement. And once you get down that phase.
Yep.
All right, John, let's switch to diversification.
Sure.
What is that and what does it look like in a portfolio?
So the concept of diversification is having different asset classes, stocks, bonds, commodities, things like that tend to react and move to various conditions within the economy at different times for different reasons, right? So stocks go up, commodities maybe not so much, or bonds go up and commodities go down, whatever, what have you. So you got different things that move in different directions, affected by different external factors. And having a little bit in every sort of bucket helps insulate you from any one bucket being way out of favor at any given time.
So not putting all your eggs in one basket.
Not putting all your eggs in one basket. And that goes from, you can take asset classes like stocks, bonds, commodities. You can drill down into any one of those buckets where it's US stocks, international stocks, technology stocks versus utility stocks, what have you, any number of different categories like that. Same thing with bonds, right? They all kind of have different characteristics. And the idea is that they're not strongly correlated to one another, meaning they don't move in tandem with each other. So if I've got three things that all have low correlations to each other, then I'm diversified. The problem that most people have with diversification is there's always going to be something in my portfolio that for some reason doesn't do as well as everything else.
Yes.
And therefore I hate it and am inclined to want to sell it. And that's probably not the best idea. I recall one of our strategists from one of the firms mentioning something. He's like, if you don't have something in your portfolio that you just can't stand to look at, you're probably not properly diversified.
I love that. Oh, that's great. Okay, so what are some practical steps investors can take to improve diversification into the new year, aside from working with a professional? Well,
I think that always goes back to the whole rebalancing, right? Okay. Like if you've started out and working with an advisors, rules, guidelines, playbooks, what have you, that are designed to make sure we've got maximum diversification as time progresses. Those ratios, those balances, those allocations to those different asset classes will change over time. And that rebalancing process brings you back to that original allocation, which presumably is going to be well diversified if you're working with an advisor, right? They're going to have US and international and growth and value and large and small and these bonds and those commodities and all that kind of stuff. And when they rebalance, they reset you back to sort of your neutral starting point, which is all part of the plan.
Okay. Most importantly, rebalancing, diversification feels like something that needs to be left to a professional. You should not be making those decisions on your own.
I would say so, because while on the surface, it's simple, right? It's a simple concept. It's a simple idea. In execution, it's very difficult, right? Yes. It takes what I would refer to as some specialized knowledge, right? It's more than just, a little bit of this and a little bit of that, right? Building a portfolio in my mind is like baking a cake, right? We have ingredients and we have to, not only do we have to get the ingredients right, we have to get the ratios right? I have to have the right, if I'm baking a cake, I have to have the right amount of flour, the right amount of eggs, the right amount of sugar. If I get them wrong, too many eggs, not enough flour, salt instead of sugar, my cake is not going to be good.
Yep, it's not going to.
It's going to look good, but maybe it won't even look good.
Yeah,
I got really great ingredients. These are amazing. You got them all in there. This is artisan flour from a from a mill in some place, right? But I have too much of it, and this thing tastes terrible.
Yes, right? You're right. So looking at the outcome.
Yes,
John, this has been so good. My final question for you is: how can working with a financial professional make the year-end review process more effective? So everyone heard what they heard today. Yep. They love it. They know maybe they can't do it on their own, or they're feeling a little bit intimidated.
Yep.
How can a financial professional help, or what is one step they can take to start the process.
So kind of like we started is go and see your doctor, schedule that appointment, right? And working with a financial advisor is a lot like working with your doctor. You meet with your financial advisor. They're your financial physician. They meet with you, understand what's bugging you, what's wrong with you. They come up with a diagnosis, and then we work on a plan. Here's a prescription, right? Here's your asset allocation. Here's your portfolio that you should utilize. And just like so many other things, by the way, Elizabeth, in combination with diet and exercise, this medicine is going to help you get to where you have to go. The diet and exercise being the savings and the spending that we need to work on to improve your outcome, which is
so savings like a diet, and spending
exercise.
Like the discipline of exercise.
Yes. And the advisor
John,
held you accountable to that.
So good as bad.
Yeah. And just like a lot of people, you're going to say, well, John, I don't really like to save, or I don't like the diet or exercise.
Yes,
could you just give me more medicine? I know 60-40 is probably what feels right.
Yeah.
But let's make the medicine do what I'm not willing to do.
Yeah.
How do you think that's going to work?
That's such a good analogy.
That doesn't work. Because it's going to make you sick.
Yes.
Because I'm going to give you the too risky portfolio.
And you're just putting a Band-Aid on it.
And the market goes down a lot. And you get really nervous and you say, John, I can't handle this. Put me back in the 64. And you're like, oh man, now we're not going to catch the rebound.
Yes,
that's what's made you sick. And now you're actually worse off than if you'd taken the prescription and we worked on your diet and exercise habits together to help move you towards that in that right direction.
I love the analogy. I love the financial physician analogy.
Yeah.
I actually have never heard that before. So you're hearing it here first, folks. Never heard that before, but you're so right.
Yeah.
And same thing with your health. If you've been avoiding going to the doctor, the best thing to do is you just got to go. You just got to go, see where you are, get it done.
Yeah. You never know. Maybe it's not as bad as you think.
Exactly.
It might not be as bad as you think.
Exactly. And same thing with a financial professional. You just got to go, see where you are and take an action, which will make you feel so much better and help you sleep at night.
Yes, absolutely.
John, it has been such a pleasure having you on the show. We always have such a great conversation. I hope everyone who's listening learned a ton from John. And if you have any questions, you could reach out to us at barnardfinancialgroup.com. Everything is in the show notes. And I hope everybody has a great rest of the day.
Thanks for having me.
Thank you for listening to Master Your Money and Mindset. You can find these episodes on YouTube or wherever you listen to your podcasts. Don't forget to like and subscribe if you enjoyed what you heard. You can follow Barnum Financial Group on LinkedIn and Instagram. Thanks so much.
All opinions expressed by the program participants are solely their current opinions and do not reflect the opinions their respective parent companies or affiliates or the companies with which the program participants are affiliated. Investments or strategies mentioned in this program may not be suitable for you, and you should make your own independent decision regarding them. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You should strongly consider seeking advice from your own investment advisor. Securities and investment advisory services offered through qualified registered representatives of MML Investor Services, LLC. Member SIPC, 6 Corporate Drive, Shelton, Connecticut, 06484, telephone number 203-513-6000.